Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and entertainment purposes only. The information shared here is based on my personal research and experience and should not be considered professional financial advice. Always consult with a qualified professional before making any financial decisions, and be sure to read all the terms and conditions of any insurance policy you're considering. Your own rates and experiences may vary. What if I told you the secret to potentially saving hundreds of dollars on your car insurance wasn't buried in some complicated comparison website, but was sitting right there in the same warehouse where you buy your rotisserie chicken and your 48-pack of toilet paper? It sounds almost ridiculous, right? We've been trained to think that finding a good deal on insurance requires hours of painful research, endless phone calls, and deciphering language so confusing it feels like it was written by lawyers for other lawyers. But the truth is, one of the most powerful, yet overlooked, insurance discounts in America is available exclusively to Costco members. And most members walk right past it, completely unaware. The average American driver overpays for car insurance by more than $400 a year. For many families, especially those with multiple cars or a team driver, that number can easily swell to over $1,000. $1,000? That's a vacation. That's a big chunk of a credit card paid off. That's an emergency fund. It's real money that's leaving your bank account every single year, often for the exact same coverage you could be getting for less. So here's the mission for this video. We are going to pull back the curtain on the Costco auto insurance program. No fluff, no marketing hype. Just a complete step-by-step breakdown of how it works, who it's for, and most importantly, whether it can actually save you a significant amount of money. By the end of this, you will know exactly how to get a quote, how to compare it apples to apples with your current policy, and you'll understand the hidden benefits and potential drawbacks that nobody ever talks about. You'll be armed with everything you need to make a smart decision and potentially stop that $1,000 leak in your budget. I'll admit I was a huge skeptic. I've been a loyal Costco member for over a decade. I've bought the tires, the TVs, the giant tubs of peanut butter pretzels. But I always saw that little insurance kiosk or the flyer in the mailer and thought, nah, that can't be a real deal. It's probably just some bare bones, low-quality coverage. Then, my own insurance premium jumped by 20% for absolutely no reason. No tickets, no accidents, nothing. Just inflation, I guess. That was the final push I needed. I decided to put my skepticism aside and actually go through the process. And what I discovered was genuinely surprising, and frankly, it changed the way I think about buying insurance. To really understand this, we're going to do a deep dive. First, we'll uncover the single most important fact about this program. Who is the company actually behind it? Because here's a spoiler. Costco is not an insurance company. Knowing who you're really dealing with is critical. Then, we'll dissect the legendary Costco member discount. Is it a real, tangible number? How much is it? What are the requirements to get it? And are there other exclusive perks that come with it? After that, I'm going to walk you through the entire quote process screen by screen. I'll show you the exact information you need to have ready, the tricky questions to watch out for, and how to make sure you're getting a quote for coverage that actually protects you. We'll then analyze the policies themselves. Is it just basic liability? Or can you get premium features like new car replacement or gap insurance? And we'll talk about one of the most valuable and unheard of benefits they offer, lifetime renewability. Finally, the moment of truth. We will take a real quote from the Costco program and put it head-to-head against quotes from the big names you see on TV every 5 minutes. The Geicos, the Progressives, the State Farms, so you can see the raw numbers and the real-world difference for yourself. Okay, let's start with the absolute foundation. The first thing you must understand is that Costco does not sell you car insurance. They don't underwrite your policy, they don't handle your claims, and they don't have a team of actuaries hiding out in the tire center calculating your risk profile. Costco is, in essence, a massive trusted marketing partner. They have leveraged their enormous and incredibly loyal membership base to negotiate a special group rate deal with a single, dedicated insurance carrier. So who are you actually buying from? The program is called Connect, and it is powered by American Family Insurance. Now, if the name American Family doesn't immediately ring a bell, don't worry. They aren't some small, regional player or a risky startup. American Family, or AmFam, as they're often called, is a behemoth in the insurance world. They are a Fortune 500 company that has been around for nearly a century. Since 1927, they consistently receive an A rating for financial strength from AM Best, which is the industry's gold standard report card. It basically means that, according to the top rating agency, The company has an excellent ability to meet its ongoing insurance obligations. In plain English, they have the money to pay your claim. This is the most critical piece of the puzzle. You're not getting a Costco policy. You're getting an American Family policy with a Costco discount baked in. When you have an accident and need to file a claim, you won't be calling the customer service desk at your local warehouse. You'll be dealing with the claims department of a massive, established, and financially stable insurance company. Costco simply acts as the gatekeeper. They've put their stamp of approval on this provider and have used their immense negotiating power, the power of over 120 million card-carrying members, to secure a deal that isn't available to the general public. Think about it from a business perspective. Why would a giant like American Family do this? It all comes down to one thing: the cost of acquiring a customer. The big insurance companies spend billions, with a B, every single year on advertising. The Geico Gecko, Flo from Progressive, the Allstate Mayhem guy, Jake from State Farm, you are paying for those commercials. That multi-billion-dollar marketing budget is factored directly into the price of your premium. By partnering with Costco, American Family gets to bypass a huge chunk of that expense. They get direct, exclusive access to a massive pool of pre-qualified customers who are known to be loyal and have a built-in trust for the Costco brand. They don't need to run Super Bowl ads to reach you. They just need to be in the Costco ecosystem. And the money they save on marketing and advertising can then be passed on to you, the Costco member, in the form of a discount. It's a brilliantly simple business model that benefits both the insurer and the customer. So now we know it's a legitimate, major insurance company pulling the strings. We know the business model makes sense. But that brings us to the real million-dollar question: what about that discount? Is it just a tiny token percentage? Or is it a game changer? How much is it really? Does every single member get it? And how does it stack up against the other discounts you might be giving up by switching from your current provider? That's exactly what we're going to break down next. First, let's pull back the curtain on the single most misunderstood part of this entire program. Costco itself is not an insurance company. They don't have underwriters, they don't process claims, and they don't set your premium. When you get Costco insurance, you're not actually buying a policy from the same people who sell you a 5-pound bag of gummy bears. Instead, Costco has leveraged its massive, loyal membership base, we're talking over 100 million people, to negotiate a special group rate with an actual insurance carrier. That carrier is a company called Connect, which is a part of American Family Insurance. AmFam is a huge, well-established player in the insurance world, a Fortune 300 company. This isn't some fly-by-night startup. So the Costco member discount isn't a coupon. It's a pre-negotiated group benefit, kind of like a corporate discount an employer might offer its employees. Costco is acting as the world's biggest, most diverse employer, and they've gone to bat for their employees, the members, to secure a favorable deal. So how much is that deal actually worth? This is where it gets tricky, and where the answer shifts from a simple number to "it depends." The discount isn't a flat 10% off your total bill. It's an exclusive discount applied during the complex calculation of your premium. Think of your insurance premium like a cake recipe. Your age, your driving record, your zip code, the car you drive, those are all the base ingredients: the flour, the sugar, the eggs. The insurance company mixes all those together to come up with a base price. Then they start adding in the flavorings, the discounts. A multi-policy discount, a good student discount, a safe driver discount. The Costco member discount is just one of those flavorings. For some people, based on their specific recipe of risk factors, that one flavoring makes a massive difference, turning a bland cake into a masterpiece of savings. For others, their recipe is already so complex or perhaps so risky that the Costco discount barely registers. It's a single drop of vanilla in a giant vat of batter. This is why you'll see one person on a Reddit forum screaming from the rooftops that they saved $800 a year, while another person in the very next comment says their quote was $200 higher than their current policy with Progressive. Both of them are telling the truth. Their underlying recipes were just completely different. This brings us to the most critical question of all. Does every single Costco member actually get this discount and this coverage? The answer, and this is a big one, is a hard no. Your Costco card is not a golden ticket. It's more like a key that lets you knock on Connect's door. They still have to decide if they want to let you in. Connect, powered by American Family, is the underwriter. They are the ones taking on the financial risk if you get into an accident. Therefore, they have the final say on who they're willing to cover. A Costco membership doesn't erase a bad driving record. If you have multiple at-fault accidents, a DUI, or a stack of speeding tickets, Connect will likely see you as too high risk and politely decline to offer you a policy. Your membership status is irrelevant at that point. Another major roadblock is a lapse in coverage. If you've let your previous insurance policy expire, even for a few days before trying to get a new one, you are a giant red flag to almost every insurance carrier, including Connect. To them, a lapse in coverage signals instability. They don't know why you were uninsured. Did you forget? Did you not pay your bill? Were you trying to save a few bucks by driving unprotected? They don't care about the reason. They just see the risk. Statistically, drivers with lapses in coverage are more likely to file claims. So, if you have a recent lapse, be prepared for a potential denial, or at the very least, a significantly higher premium. Your Costco membership can't fix that. The type of vehicle you drive also matters. If you're trying to insure a Lamborghini, a heavily modified street racer, or a rare import, you'll likely be turned away. These are specialized risks that mainstream insurers like Connect typically avoid. And finally, there's the state you live in. Insurance is regulated at the state level, and the program isn't even available in all 50 states. As of right now, there are a handful of states where you just can't get it, including places like Alaska, Louisiana, Maine, and Wyoming, among others. So before you even get your hopes up, you have to make sure the program is offered where you live. So let's assume you pass the test. You have a clean record, continuous coverage, a standard car, and you live in a state where the program is offered. You're a prime candidate. Now we have to talk about the hidden cost of switching, the discounts you might be leaving on the table with your old company. This is the part of the equation almost everyone forgets. They see a lower number on the Costco quote and they jump without realizing what they're giving up. The biggest one is the loyalty discount. Have you been with your current insurer for 5, 10, 15 years? You are almost certainly getting a significant loyalty or tenure discount, which can be as high as 15 or even 20%. The second you switch to Connect, that discount evaporates. It resets to zero. You're a brand new customer again. You have to ask yourself if the new Costco discount is big enough to offset the loss of your long-standing loyalty discount. Sometimes it is, many times it isn't. Next is the bundling discount. The Costco program through Connect allows you to bundle auto and home insurance, and they give you a discount for that. But what if your current provider, let's say State Farm, also bundles your auto, home, and $1 million umbrella policy? Or maybe your life insurance? Connect doesn't offer all of those other products. So by moving your auto and home to Connect, you might save $100 on those policies. But your umbrella and life insurance premiums back at State Farm could suddenly shoot up by $200 because they're no longer part of a bundle. You've taken one step forward and 2 steps back. You have to look at your entire insurance portfolio, not just the auto policy in isolation. Then there are the affinity and professional discounts. Are you a teacher, an engineer, a nurse, a member of the military, or an alumnus of a certain university? Your current carrier might be giving you a special discount for that affiliation. You need to check if Connect offers the exact same discount for your profession or group. They have a list, but it might not include your specific organization. That's another 5 or 10% you could be leaving behind. And what about telematics? Those little plugins or smartphone apps like Progressive Snapshot or State Farm's Drive Safe and Save that monitor your driving habits. If you're a genuinely safe driver who brakes smoothly and avoids late-night trips, you could be getting a massive discount, sometimes up to 30%, from one of those programs. While Connect does have a telematics program of its own, you can't assume their algorithm will reward you in the same way, or that their discount will be as generous. You're starting from scratch, and your proven track record of safe driving with your old company's app means nothing to the new one. So when you add it all up, the lost loyalty, the broken bundles, the missing affinity discounts, that shiny new Costco quote might not look so shiny after all. It's a complex puzzle, and the only way to solve it is to compare not just the final price, but the entire structure of discounts and benefits you're getting versus what you're giving up. So, with all these variables, the underwriting hurdles, the state-by-state differences, and the discounts you might lose, how do you actually figure out if it's worth it for you? How do you navigate the quote process itself to get the most accurate, apples-to-apples comparison? What are the hidden traps on the application form that can dramatically swing your premium by hundreds of dollars depending on how you answer? That's what we're diving into next. We're going to walk through the entire process screen by screen, and I'll show you the exact questions you need to pay very close attention to. Alright, let's pull up the Costco website. First things first, you're not going to find car insurance in the search bar with the Kirkland signature products. You need to navigate to the Services tab. Once you're there, you'll see a whole menu of options. Everything from water delivery to payment processing. We're looking for auto and home insurance. Click on that. This takes you to the landing page for the program, which is officially called Connect, powered by American Family Insurance. Right away, they hit you with the main value proposition, the exclusive discount for Costco members. They'll have some marketing copy about great service and claims handling, but our focus today is on the numbers. So we're going to click that big, inviting button that says, Get a quote. The very first thing it asks for is your zip code. This is your first and arguably one of the most important rating factors. Before you've even entered your name, the insurance company is already making calculations. Are you in a dense urban area with a high rate of accidents and theft? Or a quiet rural town where the biggest risk is a deer jumping out in front of you? Your zip code tells them a story about risk, and that story sets the baseline for your entire premium. After the zip code, you'll land on the main questionnaire. It starts with the basics, your personal information, name, address, date of birth. This all seems straightforward, but let's break down why they need it. Your name and address are for identification, obviously, but the address you enter here is what they call your garaging address, where the car is primarily kept. This refines the risk assessment from your zip code down to your specific neighborhood. Your date of birth is critical. Age is a massive factor in insurance pricing. Younger, less experienced drivers statistically have more accidents, so they pay significantly more. Rates typically start to drop around age 25 and continue to improve into your 50s and 60s, assuming you maintain a clean record. Okay, now we get to the fun part, the vehicles. This is where the details really matter. You'll have the option to add your car by entering the vehicle identification number, the VIN, or by manually selecting the year, make, and model. My advice? If you have it handy, always use the VIN. The VIN is like your car's social security number. It tells the insurance company everything, not just the make and model, but the specific trim level, the engine size, and most importantly, all the factory-installed safety features. Anti-lock brakes, airbags, electronic stability control. The VIN decodes all of that, and each of those safety features can chip away at your premium. Manually entering the information is fine, but you might miss out on a discount if you forget to check a box for a safety feature your car has. Next up, a series of questions about how you use the car. This section is a minefield of potential mistakes. The first question is primary use. The options are usually something like commute, pleasure, business, or farm. Let's be clear. Pleasure means you're just driving for personal errands, weekends, that sort of thing, no regular back and forth to a job. Commute means you use the car to drive to and from work or school on a regular basis. If you select commute, it will trigger the next critical question. How many miles do you drive one way and how many days a week? This flows directly into the estimated annual mileage question. This is one of the biggest levers you have on your premium. Do not just accept the default, which is often 10,000 or 12,000 miles. Think about it. The less you're on the road, the less risk you represent. Someone driving 5,000 miles a year is statistically far less likely to get into an accident than someone driving 20,000 miles a year. So how do you get an accurate number? Don't guess. The best way is to look at your last 2 oil change receipts. They'll have the date and the odometer reading. See how many miles you drove between those 2 dates, and then calculate what that would be for a full year. Or use Google Maps to calculate your daily round-trip commute. Multiply it by the number of days you work a week. Then multiply that by the number of weeks you work a year. Then add a buffer, maybe 2,000 or 3,000 miles for all your other driving. Getting this number right can easily swing your premium by 10 to 15%. Then comes ownership. Is the car owned, financed, or leased? This question isn't about your personal wealth. It's about required coverages. If you put owned, it means you have the title free and clear. You own it outright. In this case, you have the freedom to choose whatever coverages you want, as long as you meet your state's minimum liability requirements. However, if you select financed or leased, you are telling the insurance company that a bank or a leasing company has a financial interest in your vehicle, and that bank is going to require you in your financing contract to carry full coverage. That means both collision and comprehensive. Collision covers damage to your car from an accident, and comprehensive covers things like theft, fire, vandalism, or hitting a deer. If you have a loan, you cannot legally drop these coverages to save money. The system knows this, and it will often default to including them in your quote if you select financed or leased. Now let's move on to the drivers. Just like the car, every person you list on the policy has their own set of questions. It'll start with the basics: name, date of birth, gender. Then it asks for marital status. Why do they care if you're married? Statistics. Decades of data show that married individuals, on average, file fewer claims than single individuals. So, being married will almost always result in a lower premium. It's a simple checkbox that can save you real money. Next, it will ask for your driver's license number, the state it was issued in, and for how long you've been licensed. This years of driving experience is a huge deal. A 40-year-old who just got their license for the first time is seen as a much higher risk, essentially a brand new driver, than a 40-year-old who has been licensed since they were 16. Then you get into a few questions that might surprise you: education level and occupation. Yes, your job and your degree can affect your car insurance rate. Again, it's all about statistics. The data shows that people in certain professions, like teachers, engineers, scientists, and first responders, and those with higher levels of education tend to be more risk-averse and have fewer accidents. So, if you have a bachelor's degree or higher, make sure you indicate that. When you get to the occupation drop-down, find the category that best fits your job. It might not be a perfect match, but choose the closest one. This won't be a massive discount, but we're trying to stack every single small advantage we can get. Finally, we arrive at the most important part of the driver section: your driving history. It will ask you about any accidents, claims, or traffic violations, like speeding tickets or running a red light, within the last 3 to 5 years. And it will ask about major violations like a DUI, which can stay on your record for much longer. I cannot stress this enough. Be 100% truthful here. It is pointless to lie. The very next step in the insurance company's process, after you submit this quote, is to run your information through 2 massive databases. They'll pull your motor vehicle report, or MVR, from the DMV, which lists all your violations. And they'll pull a CLUE report, which is a database of all prior insurance claims you've made, even with other companies. If you fail to disclose an accident or a ticket, they will find it. The best case scenario is they'll just adjust your quote to the correct, higher price. The worst case scenario is they could deny your application or, even worse, approve your policy, and then cancel it a few weeks later for misrepresentation, leaving you scrambling to find new insurance. So be honest. List everything. The quote you get might be higher, but at least it will be real. So as you can see, every single one of these boxes, from your zip code to your job title, is a piece of a giant puzzle. The insurance company is taking all of this data to build a profile of you and your vehicle to predict the likelihood that you will cost them money in the future. Now that we've input all the information about who we are, what we drive, and how we drive, the next step is to choose what we're actually buying, the coverages. And this is where you have the most direct control over your final price. Picking the right liability limits, deductibles, and optional coverages is the difference between being properly protected and being dangerously underinsured. Let's start with the absolute foundation of any auto policy: liability coverage. This isn't for you. This is for the other guy. If you cause an accident, liability is what pays for the other person's car repairs, their medical bills, their lost wages, even their pain and suffering. It is the single most important coverage you can buy, because it's what protects your entire financial life, your savings, your home, your future earnings, from a lawsuit that could wipe you out. When you get to this section in the Costco quote, you'll likely see it broken into 2 parts: bodily injury and property damage. And you'll see 3 numbers, something like 25/50/25 or 100/300/100. Let's decode this because it's critical. The first number is the maximum amount, in thousands, that your insurance will pay for any one person's injuries in an accident you cause. The second number is the maximum they'll pay for all injuries combined in that same accident. So, with a 100/300 limit, they'd pay up to $100,000 for one person, but no more than $300,000 total, even if you injure 5 people. Now here's the trap most people fall into. They see their state's minimum requirement, maybe it's $25.50, and they think, great, I'm covered. That is dangerously wrong. A $25,000 limit for bodily injury can be exhausted by a single ambulance ride and a few hours in the emergency room. A serious multi-day hospital stay can easily top 6 figures. If you cause an accident and your insurance runs out, guess who the other person's lawyer is coming after for the rest? You. They can garnish your wages, put a lien on your house. Everything you've worked for is on the line. This is why you'll often hear financial advisors recommend liability limits of at least 100/300, or even better, 250/500 if you can afford it. It's the cheapest way to buy yourself millions of dollars in potential protection. The third number in that sequence is for property damage. This is what pays to repair or replace whatever you hit, whether it's another car, a guardrail, a storefront, you name it. Again, the state minimum might be as low as $10,000 or $15,000. Think about the cars on the road today. The average new car costs over $45,000. What happens if you rear-end a brand new Ford F-150 or a Tesla, or cause a chain reaction involving 3 cars? Your $15,000 limit is gone in an instant, and you are personally on the hook for the rest. I always recommend a minimum of $100,000 in property damage liability. The cost to increase it from, say, $25,000 to $100,000 is usually shockingly small. We're talking a few dollars a month for an extra $75,000 of protection. It's the best bargain in insurance. Okay, so we've covered your responsibility to others. Now let's talk about protecting yourself from the irresponsible. This brings us to uninsured and underinsured motorist coverage, or UM and UIM. This is one of the most important and tragically overlooked coverages on a policy. The reality is, an estimated 1 in 8 drivers on the road in the United States has no insurance at all. None. If one of them plows into you and puts you in the hospital, their non-existent insurance isn't going to pay your medical bills. That's where your uninsured motorist coverage kicks in. It acts like the at-fault driver's insurance, paying for your medical expenses, your lost wages, and your pain and suffering. But what about the driver who followed the law and bought insurance, but only the rock-bottom state minimum? This is where underinsured motorist coverage saves the day. Let's say that driver has a $25,000 liability limit, but your medical bills from the accident are $125,000. Their insurance pays its max of $25,000, and then that's it. You're left with a $100,000 hole. But if you have underinsured motorist coverage, your own policy steps in to cover that difference, up to your policy limit. It's a financial lifesaver. When you're getting your Costco quote, you'll typically be able to select UM and UIM limits that match your own liability limits. My advice? Always match them. If you believe you're worth protecting others for $100/$300, you should believe you're worth protecting yourself for the same amount. Next up, you'll likely see options for medical payments, often called MedPay, or in some states, personal injury protection or PIP. These are similar but have key differences. Both are designed to pay for your medical expenses and your passengers after an accident, regardless of who was at fault. It's immediate coverage. You don't have to wait for lawyers to argue for 6 months. MedPay is straightforward. It pays for medical bills up to a set limit, usually something like $5,000 or $10,000. It's great for covering your health insurance deductible or co-pays. PIP, which is mandatory in no-fault states, is more comprehensive. It not only covers medical bills but can also cover lost wages and the cost of hiring someone to do household chores you can't do while you recover. When selecting this, think about your health insurance. If you have a fantastic plan with a low deductible, a smaller MedPay limit might be fine. If you have a high deductible plan or no health insurance, then a higher MedPay or PIP limit is absolutely essential. So far, we've covered all the things that happen to people. Now let's talk about the car itself. This section is all about physical damage, and it's broken into 2 famous parts: collision and comprehensive. If you have a loan or a lease on your car, your lender will require you to have both of these. No exceptions. Collision is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. Another car, a pole, a curb, a wall, even if you flip it over. The key thing here is that it pays out regardless of who is at fault. Even if the accident was 100% your fault, collision coverage will fix your car. This is where you'll choose your deductible. The deductible is the amount of money you have to pay out of pocket before the insurance company starts paying. A common deductible is $500 or $1,000. If you have a $5,000 repair bill and a $1,000 deductible, you pay the first $1,000, and the insurance company pays the remaining $4,000. The trade-off is simple. A higher deductible means a lower monthly premium, because you're taking on more of the initial risk. A lower deductible means a higher premium, but less financial pain if you have to file a claim. The other half of the physical damage puzzle is comprehensive coverage, sometimes called other than collision. This is the coverage for all the weird random stuff that can happen to your car. A deer runs out in front of you? That's a comprehensive claim. Your car is stolen? Comprehensive. A hailstorm turns your roof into a golf ball? Comprehensive. A tree branch falls on it, it catches fire, it's vandalized, you hit a turkey, a rock cracks your windshield. All of that is comprehensive. Just like collision, you'll select a deductible for this coverage. Many people choose a lower deductible for comprehensive, like $250 or $500, because these claims are often less severe and more frequent than major collisions. Finally, we get to the extras, the optional coverages that can make a huge difference in your experience after an accident. You'll see things like roadside assistance. For just a few dollars a month, this adds coverage for towing flat tires, dead batteries, and locking your keys in the car. It's often cheaper than a separate AAA membership and incredibly convenient. Then there's rental reimbursement. This is a big one. If your car is in the shop for repairs after a covered accident, this coverage pays for a rental car. Without it, you're either paying $50 a day out of pocket, begging for rides, or taking the bus. With it, you just pick up your rental and your life continues with minimal disruption. It's usually sold in daily and total limits, like $30 a day up to a maximum of $900. I always recommend getting this. The cost is tiny compared to the headache and expense it saves you. And depending on your vehicle and the program, you might see other valuable add-ons like new car replacement, which is amazing. If your brand new car is totaled within the first year or so, instead of just giving you a check for its now depreciated value, they'll pay to replace it with a brand new car of the same make and model. For anyone with a new car loan, this can be a huge financial relief, working hand in hand with another potential option. Gap insurance, which pays the difference between what your car is worth and what you still owe on your loan if it's totaled. As you can see, this section is where you're not just a price shopper, you're a risk manager. You are actively building a shield to protect your car, your health, and your entire financial future. Every choice you make here, from your liability limits to your deductibles, has a direct and meaningful impact. So, with that risk manager mindset firmly in place, let's start building your shield. The journey begins on the Costco website. You'll navigate to the Services section and find the Auto and Home Insurance link. This isn't a Costco-branded insurance company. It's a member-exclusive program administered by Connect, which is a part of American Family Insurance. This is a critical distinction. Costco didn't just decide to become an insurance carrier overnight. They used their immense buying power and their legendary focus on member value to vet and partner with a high-quality, established insurer, and then negotiated special discounts and perks just for their members. You're leveraging Costco's reputation to get a preferred rate. Once you click through, you'll land on the Connect portal. The very first thing it asks for is your zip code. This seems simple, almost trivial, but this 5-digit number is the cornerstone of your entire quote. It's the first and arguably one of the most powerful data points the insurance algorithm uses. Why? Because insurance is a game of localized statistics. Your zip code tells the insurer about the frequency of accidents in your area, the rates of auto theft and vandalism, the cost of vehicle repairs at local body shops, the likelihood of weather events like hail or flooding, and even the litigation climate, how likely people are to sue after an accident. Two people with identical cars and driving records could have wildly different premiums if one lives in a dense urban center and the other in a quiet rural suburb. This first step immediately places you on a geographic risk map. After entering your zip code, you'll begin the personal information section. Name, date of birth, address. Again, let's look behind the curtain. Your name is for identification, obviously. Your address confirms the garaging location of your vehicle, reinforcing the data from your zip code. But your date of birth? That's a powerhouse rating factor. Decades of data show a strong correlation between age and driving risk. Younger, less experienced drivers statistically have more accidents, so their premiums are higher. As you move into your late 20s, 30s, 40s, and 50s, rates typically decline, reflecting experience and, statistically speaking, a more settled lifestyle. Then, as drivers enter their senior years, rates can begin to creep back up, reflecting potential changes in reflexes and vision. It's not personal. It's pure, cold, hard data averaged over millions of drivers. Next, you'll arrive at the heart of the matter: your vehicles. You'll need the year, make, and model of each car you want to insure. But here's the first major pro tip. Always use the vehicle identification number, or VIN if you can. Don't just manually select Honda Accord. Why? Because there isn't just one Honda Accord. There's the LX, the Sport, the EXL, the Touring. Each of these trim levels has different features, a different sticker price, and therefore a different cost to repair or replace. The VIN is your car's unique fingerprint. When you enter it, the system doesn't just see Honda Accord. It sees the specific engine size, the exact safety features like anti-lock brakes, electronic stability control, and the number of airbags. It knows if your car came from the factory with an anti-theft immobilizer, Each of these details can trigger small discounts that add up. Manually selecting your car is like describing a person by their hair color. Using the VIN is like giving their DNA sample. It's infinitely more accurate. Once the vehicle is identified, the system will ask you about its usage. This is another crucial area. You'll typically see options like commute, pleasure, or business. Be honest here. Pleasure use means you're not using it for a daily commute to work or school. It's for errands, weekend trips, that sort of thing. This generally results in a lower premium. Commute means you drive it back and forth to a single work location. The system will then ask for the one-way distance of that commute. A 5-mile commute is less risky than a 50-mile commute, and your rate will reflect that. Business use is for when the vehicle is an essential part of your job. Think a real estate agent driving clients around or a salesperson making calls across a territory. This usually carries the highest premium because the vehicle is on the road more, often in unfamiliar areas and during peak traffic hours, increasing the risk of a claim. Tied directly to this is your estimated annual mileage. This is one of the most heavily weighted factors in your premium. More miles means more exposure to risk. A person driving 5,000 miles a year is statistically far less likely to have an accident than someone driving 20,000 miles. But how do you accurately estimate this? Don't just guess. A good method is to look at your last 2 service records. They'll have the odometer reading on them. Subtract the older reading from the newer one, and you'll know how many miles you drove in that period. You can then project that out for a full year. If you've had the car for a while, you can even divide the total miles you've put on it by the number of years you've owned it. Underestimating your mileage might give you a lower quote initially, but it can cause major problems. If you have a claim and the insurance company sees your odometer is way higher than what you stated, they could re-rate your policy and backcharge you for the difference, or in extreme cases, even deny the claim based on material misrepresentation. The final piece of the vehicle puzzle is ownership. Is the car owned outright, financed, or leased? This isn't just a casual question. It directly impacts the coverages you'll be required to carry. If you own the car free and clear, you have the freedom to choose whatever coverages you want within state law. You could, in theory, carry only liability insurance. However, if you have a loan on the car or you're leasing it, that's not the case. The bank or leasing company is the legal owner until you pay it off. They have a financial interest to protect. Therefore, your financing or lease agreement will contractually require you to maintain both collision and comprehensive coverage, often with a maximum deductible of $500 or $1,000. This protects their asset, your car, from damage or theft. When you select financed or leased in the quote, the system will often automatically add these coverages because it knows they're not optional for you. With the vehicle details locked in, the focus shifts to the drivers. You need to list every licensed driver in your household and anyone else who drives your car on a regular basis. This includes your spouse, a licensed teenager, or even a roommate who occasionally borrows the car. The principle is that the premium must reflect the risk of everyone who has regular access to the keys. For each driver, you'll enter their information, much like you did for yourself. And here we see more rating factors at play. Marital status, for example. Why do they ask this? Again, statistics. Data shows that, on average, married individuals file fewer claims and are involved in fewer accidents than single individuals of the same age. This leads to a small married discount. They will also ask about education level and occupation. This can feel intrusive, but it's another powerful statistical tool. Certain professions and higher levels of education have a statistical correlation with lower risk driving behavior. Engineers, scientists, teachers, and pilots, for example, often receive discounts because the data pool for those professions shows a lower than average loss ratio. It's not a judgment on your intelligence or character. It's another layer of statistical analysis. Finally, and most importantly, you'll be asked about each driver's history for the past 3 to 5 years. This means accidents, whether you were at fault or not, traffic violations like speeding tickets or running a red light, and any previous insurance claims. This is the moment of truth. My advice is simple. Be completely 100% transparent. The insurance company is going to find out anyway. As part of their underwriting process, they will pull 2 key reports. The first is your motor vehicle report, or MVR, from the DMV, which lists all your traffic violations. The second is a CLUE report, which stands for Comprehensive Loss Underwriting Exchange. Think of it as a credit report for your insurance history. It lists every auto and property claim you filed for the past 7 years. If you forget to mention that speeding ticket from last year or the fender bender you had 2 years ago, the system will generate a lovely, low quote. You'll feel great. But a few days later, after you've paid and they've run your reports, you'll get an email explaining that your premium has been adjusted upwards by 30%. All you accomplished by omitting the information was wasting your own time and getting an inaccurate picture of the cost. By putting everything on the table up front, the quote you receive is the price you'll actually pay. You are building a profile of your household's risk, and every piece of data, from your zip code to your job to that forgotten parking ticket, is a block in that foundation. And once that foundation is built, the real work begins. The system takes these blocks of data and runs them through a sophisticated, multi-layered algorithm. Think of it less like a simple calculator and more like a high-speed, digital actuary sitting in a virtual room, poring over every detail of your life. This isn't a Costco-specific secret, by the way. Every major insurer uses a similar process. What makes the Costco program through Connect unique are the specific weights they assign to each factor and, of course, the member discount that gets applied at the end. But to understand how you get to that final number, we need to pull back the curtain on the 3 core pillars of any auto insurance quote: the car, the driver, and the environment. Let's start with the most obvious one: your vehicle. When you punch in your car's year, make, and model, you're giving the system its first major data point. But it goes so much deeper than just knowing you drive a Ford F-150. The system is instantly accessing a massive database that contains decades of information about that specific truck. It knows statistically how likely an F-150 is to be in an accident. It knows the average cost to repair it after a fender bender, which, thanks to modern sensors and aluminum body panels, is a lot more than it used to be. It knows the theft rate for that model in your region. Certain vehicles, like some models of Hyundai and Kia, have become infamous for being easy to steal, causing their insurance rates to skyrocket in some cities. Your reliable Honda Accord? It might be a target for thieves looking to strip it for parts. That brand new electric vehicle? The battery alone can cost $20,000 to replace, a risk the insurer has to price in. This is why the Vehicle Identification Number, or VIN, is so critical. The VIN is the social security number for your car. It tells the insurer not just that you have a 2023 Toyota RAV4, but that you have the XLE premium trim with the optional technology package and a specific factory-installed anti-theft system. Every single detail is encoded in those 17 digits. This allows the insurer to pinpoint the exact replacement cost and repair complexity. They can see if your model has advanced safety features like automatic emergency braking or blind spot monitoring. These aren't just bells and whistles. They are statistically proven to reduce the frequency and severity of accidents. A car that can brake for itself is less likely to rear-end someone in stop-and-go traffic. That translates directly into a lower risk for the insurer and a potential discount for you. So when you enter that VIN on the Costco auto insurance form, you're giving them the key to a treasure trove of data that immediately begins shaping your premium. Next, we move to the second pillar, which is arguably the most important: you, the driver. This is where the profile of risk becomes intensely personal. Your age, your gender, your marital status, these are the broad strokes. Decades of data show that a 45-year-old married woman has a different risk profile than a 19-year-old single man. But the real meat is in your history. When you give them your driver's license number, you are giving them permission to pull your motor vehicle report, or MVR. This is the official record of your driving life, held by your state's DMV. Every speeding ticket, every moving violation, every at-fault accident, it's all there. A single speeding ticket from 2 years ago might only nudge your rate up slightly, but a DUI conviction? That's a 5-alarm fire for an insurance company. It signals extremely high-risk behavior, and your premium will reflect that for years to come. The system doesn't just see a ticket, it sees the severity. A ticket for going 10 miles over the speed limit is viewed very differently than a ticket for reckless driving at 100 miles per hour. The MVR is the insurer's window into how you actually behave behind the wheel, separate from how you say you behave. That forgotten parking ticket from last year? You can relax. Non-moving violations like parking tickets or a broken taillight generally don't show up on your MVR and don't impact your insurance rates. It's the violations that demonstrate risky driving that they care about. But there's another report they pull, one that most people have never even heard of. It's called the CLUE report, which stands for Comprehensive Loss Underwriting Exchange. Think of it as the credit report for your insurance history. This report, compiled by a consumer reporting agency called LexisNexis, lists every auto insurance claim you've filed over the last 7 years, regardless of which company you were with. When the Costco quote form asks, "Have you had any claims in the past 5 years?" they already know the answer. The CLUE report shows them the date of the loss, the type of loss, collision, theft, liability, and how much the insurance company paid out. If you had a minor fender bender where you paid out of pocket to avoid a claim, that won't be on there. But anytime an insurer cut a check, it's recorded. This is also where your history of continuous coverage comes into play. If you let your insurance lapse for a month or two because you were between cars or just forgot to pay, that's a major red flag. To an insurer, a lapse in coverage suggests instability and a higher likelihood of being an uninsured driver, which is a significant risk. Maintaining continuous coverage, even if you switch companies, shows them you are a responsible insurance consumer. This is why it's so important to be honest on your application. If you conveniently forget to mention the accident you had 3 years ago, the CLUE report will tell them the real story, and your quote will either be adjusted, or the insurer might even decline to offer you a policy at all for material misrepresentation. Finally, we have the third pillar, the environment. This is where you live and drive. The first data point here is your estimated annual mileage. It's simple math. The more you're on the road, the more chances you have to get into an accident. Someone with a 50-mile round-trip commute in rush hour traffic is a higher risk than a retiree who only drives a few thousand miles a year to the grocery store and the golf course. That's why they ask if your primary use is for commuting, pleasure, or business. But the single biggest environmental factor is your garaging address, your zip code. This can feel unfair. You might be the safest driver in the world, but if you live in a densely populated urban zip code, you're going to pay more than an identical driver living in a rural area. Why? Because risk is communal. In a city, there are more cars, more intersections, more pedestrians, and more chances for accidents, theft, and vandalism. The insurer isn't just insuring you. They're insuring you against the chaos of your environment. They look at the weather patterns in your zip code. Do you live in a part of Texas prone to catastrophic hailstorms? That increases the risk of comprehensive claims. Do you live in a coastal area of Florida with a high risk of flooding? That's another risk factor. They even look at things like the cost of auto repairs and medical care in your specific area. A body shop in Beverly Hills charges more than one in Bakersfield, and that's factored into the price. There's even a hidden layer to this that most people don't know about: the litigation rate. Insurers track how likely people in a certain zip code are to hire a lawyer and sue after an accident, even a minor one. In some areas, a simple fender bender is more likely to turn into a prolonged, expensive legal battle. That potential cost gets priced into the premiums of everyone who lives in that litigious area. So when you enter your zip code, the system is instantly cross-referencing it with data on traffic density, crime statistics, weather patterns, repair costs, and even the local legal climate. It all merges together, the data from your car, the history of your driving, and the risks of your neighborhood, to form that initial base premium, before any discounts are even considered. It's a complex, data-driven calculation happening in a fraction of a second, all to answer one question: how much risk do you represent? And based on that answer, how much should you pay to protect yourself? So that base rate, that's the raw, unfiltered number. It's the sticker price on the car before you even start negotiating. But nobody pays the sticker price, right? This is where the game truly begins. This is where the insurance company starts looking at you not just as a collection of risk factors, but as a person, and where you, the consumer, start to claw back some of that cost. This is the world of discounts. And it's the entire reason a program like Costco's even exists. See, you have to understand, Costco itself isn't an insurance company. They don't have legions of underwriters in the back of the warehouse next to the rotisserie chickens. The program is administered by a company called Connect, which is backed by a major insurer, American Family Insurance. So what is Costco's role? They are the ultimate gatekeeper. They've created one of the most desirable pre-vetted customer groups in the world: Costco members. Think about it from an insurer's perspective. Who is the ideal customer? Someone who is stable. Someone who is financially responsible. Someone who likely owns their own home, has a family, and has a vested interest in being safe and protecting their assets. Now describe the average Costco member. You see the overlap? By paying an annual membership fee, you've already signaled a certain level of financial planning and stability. You're statistically more likely to be a homeowner. You're part of a demographic that, on the whole, represents a lower risk to the insurance company. Insurers call this an affinity group, and they absolutely love them. They will fight to give a special discount to groups of teachers, engineers, or members of certain organizations because the data tells them that group, as a whole, files fewer and less expensive claims. Costco is arguably the king of all affinity groups. So, the very first and often most significant discount you get through this program is simply for being a card-carrying Costco member. It's not a marketing gimmick. It's a calculated reduction in your rate because you belong to a club of people who have proven, over millions of data points, to be a better-than-average risk. But that's just the first domino to fall. From there, we start building what I call the discount stack. This is where your personal details can dramatically slash that base rate. The undisputed king of all discounts is the multi-policy discount, often called bundling. This is when you insure your car and your home or apartment with the same company. The savings here can be enormous, sometimes as high as 20 or 25%. And again, it's not just because the company wants more of your business. It's a risk calculation. The data is overwhelmingly clear. People who own their homes are more stable, more settled, and file fewer auto claims than those who don't. By bundling, you are signaling to the insurer that you are a homeowner or a long-term renter, a prime, low-risk customer, and they reward you for it handsomely. Next up is the multi-car discount. This one seems a little less intuitive. Why would giving a company more vehicles to insure make them charge you less per vehicle? 2 reasons. First, administrative efficiency. It's cheaper for them to manage one policy with 2 cars than 2 separate policies. One bill, one point of contact. Second, it's another risk signal. A household with multiple cars often implies a family, which, from a data perspective, can suggest more responsible driving habits compared to a single individual with a single high-performance car. Then you have the one everyone knows, the good driver discount, also known as the safe driver discount. This is your reward for having a clean record. But how do they know? When you get a quote, you give them permission to pull your MVR or motor vehicle record from the DMV. This is your official driving report card. It lists any speeding tickets, at-fault accidents, and other violations. Most minor infractions, like a speeding ticket, will typically impact your rates for about 3 years. Major violations or at-fault accidents can stick around for 5 years or even longer. If your MVR comes back clean for that period, you unlock a significant discount. You have proven, with your real-world actions, that you are a lower risk. A fascinating one is the good student discount. This always gets questions. What does getting a B average in calculus have to do with your ability to merge onto a highway? The answer is correlation. Decades of data have shown insurance companies that students who are disciplined and responsible enough to maintain good grades are, as a group, also more responsible and less reckless behind the wheel. It's a proxy for maturity. So if you have a high school or full-time college student on your policy with a 3.0 GPA or better, you can often get a surprisingly hefty discount. You're providing the insurer with a data point that suggests your young driver is more conscientious than their peers. Of course, the car itself plays a huge role in the discount stack. This is the vehicle safety features discount. When you enter your car's VIN, the system instantly knows its safety profile. Does it have anti-lock brakes? That reduces the chance of a skid-related accident. Does it have front and side impact airbags? That dramatically reduces the severity of injuries and therefore the cost of medical claims. Does it have an anti-theft system like an engine immobilizer? That reduces the risk of a total vehicle theft. Newer features like automatic emergency braking, lane departure warnings, and blind spot detection are also starting to command their own discounts because they are proven to reduce the frequency of accidents. Each checkbox shaves a little more off your premium. In our modern, often work-from-home world, the low-mileage discount has become more important than ever. The logic is simple probability. The less time you spend on the road, the lower your chances of getting into an accident. If you drive fewer than, say, 7,500 or 10,000 miles a year, you can qualify. The insurer is rewarding you for having lower exposure to risk. And that brings us to the most modern, and perhaps most controversial discount of all, telematics. This is where you voluntarily trade your privacy for a potentially massive discount. Programs like Connect's telematics option, or others you've heard of like Progressive Snapshot, involve using a smartphone app or a small device plugged into your car. This device monitors your actual driving habits. How hard do you brake? How quickly do you accelerate? Do you speed? Do you drive late at night during higher risk hours? In essence, you are allowing the insurance company to ride shotgun with you on every trip. If you prove you are a genuinely safe, smooth, and responsible driver, your discount can be substantial, sometimes as much as 30 or 40%. It's the ultimate way of telling the insurer, "Don't judge me based on my age or my zip code. Judge me based on how I actually drive." For a safe driver, it can be a game changer. For someone with a lead foot, it's best avoided. So imagine your base premium as a tall stack of building blocks. The Costco member discount comes in and immediately knocks off the top few blocks. Then, you tell them you have a home to bundle. Bam, the multi-policy discount saws a huge chunk out of the middle. Your clean driving record shaves a few more blocks off the side. You add your second car. You prove your kid is a good student. Your car is loaded with safety features. By the time you've applied every discount you qualify for, that intimidating tower you started with can look like a shadow of its former self. And the Costco program through Connect sweetens the deal with a few unique perks that aren't just about the price. One of the most valuable is lifetime renewability. In many states, this means as long as you pay your bill and maintain a valid license, they won't cancel your policy, even if you have a couple of accidents. That is huge. Many standard insurers will drop you after 2 at-fault claims in a few years, forcing you into a high-risk pool with astronomical rates. Lifetime renewability is a powerful form of peace of mind. They also offer things like a windshield repair deductible waiver. If that rock chip can be repaired instead of the whole windshield being replaced, you pay nothing out of pocket. And for executive members, they often roll in benefits like roadside assistance. You've built your profile, the algorithm has calculated your risk, and you've stacked every discount you qualify for. The system spits out a number. But that number, that final quote, is only half the story. Because what you're actually buying isn't a price. It's a promise. And understanding that promise is the most important part of this entire process. That quote you see on the screen from Connect, powered by American Family. It's a menu. And every single line item on that menu represents a different kind of promise. A promise for what the insurance company will do when things go horribly, horribly wrong. Let's decode that menu. Because choosing the right meal is the difference between a minor inconvenience and financial ruin. First up, the big one. The one that's legally required in almost every state. Liability coverage. This isn't insurance for you. It's insurance for other people. From you. If you cause an accident, this is the part of your policy that pays for the other person's car repairs, their medical bills, their lost wages, even their pain and suffering if they decide to sue you. Think of it as your financial bodyguard. It stands between your mistake and your life savings, your house, your future earnings. On your quote, you'll see it written as a series of 3 numbers, something like 50/100/25 or 100/300/50. This isn't a secret code. It's the blueprint for your bodyguard's strength, measured in thousands of dollars. The first number is the maximum amount the policy will pay for any single person's bodily injuries in an accident you cause. The second number is the maximum total it will pay for all bodily injuries in that same accident. And the third number is the maximum it will pay for property damage, usually the other person's car, but it could also be a storefront, a telephone pole, or a very expensive mailbox. So, a 100/300/50 policy means your insurance will pay up to $100,000 for one person's injuries, up to $300,000 total for everyone's injuries in the car you hit, and up to $50,000 to fix their property. Now, here is the single most important piece of advice you will ever get about auto insurance. State minimums are a trap. They are a financial landmine. Many states only require something pathetic like 25/50/20. Let me ask you, have you seen the price of a new car lately? Hitting a new pickup truck or a Tesla could easily exceed a $50,000 property damage limit. And a serious hospital stay? That can blow past a $100,000 medical limit in a matter of days. Once the insurance money runs out, guess who they come after for the rest? You. They can garnish your wages, put a lien on your home. Everything you've worked for is on the line. The small amount of money you save by choosing lower liability limits is not worth the catastrophic risk you are taking. When you're looking at that Costco quote, increasing your liability limits is one of the cheapest ways to buy an incredible amount of peace of mind. Okay, so that's liability, it protects you from hurting others. But what about protecting your own car? That's where the next 2 coverages come in, collision and comprehensive. People mix these up all the time, but it's simple. Collision is exactly what it sounds like. It pays to repair or replace your car if you collide with another object. Another car, a guardrail, a tree, a pothole. It's the coverage for when you are at fault, or when the other driver is at fault but their insurance is dragging their feet. This is where your deductible comes into play. A deductible is the amount of money you have to pay out of pocket before the insurance company pays a dime. If you have a $500 deductible and you cause $5,000 worth of damage to your car, you pay the first $500, and the insurance company pays the remaining $4,500. A higher deductible, like $1,000 or $2,000, will lower your premium because you're agreeing to take on more of the initial risk yourself. A lower deductible means a higher premium. This is a personal choice based on how much cash you could comfortably part with on a bad day. Then there's comprehensive coverage. Think of this as the act of God or act of a criminal coverage. It covers almost everything else that can damage your car that isn't a direct collision. A tree branch falls on it during a storm. A deer decides to redecorate your front end on a country road. Your car gets hailed on and now looks like a golf ball. It gets stolen. Catches on fire. Vandalism. All of that is comprehensive. Just like collision, it has a deductible that you choose. For most people who have a car that's worth more than a few $1,000s, or especially if you have a loan or a lease on your vehicle, your lender will require you to have both collision and comprehensive. They're protecting their investment. So we have liability to protect our assets and collision and comprehensive to protect our car. We're done, right? Wrong. We've only protected ourselves from ourselves. What about everyone else? This brings us to the unsung hero of auto insurance: uninsured and underinsured motorist coverage. Let's be brutally honest. Estimates suggest that 1 in 8 drivers on the road in the United States has no insurance at all. 1 in 8. And many more are driving around with those laughably low state minimum liability limits we just talked about. So what happens when one of them plows into you and puts you in the hospital? Their insurance is non-existent, or it's tapped out after the first day in the ER. Now what? You sue them? You can't get blood from a stone. If they could afford to pay a massive judgment, they probably would have had good insurance in the first place. This is where uninsured motorist, or coverage saves you. It steps in and acts like the at-fault driver's insurance that they should have had. It pays for your medical bills, your lost wages, your pain and suffering. It protects you and your family from the irresponsibility of others. Underinsured motorist, or works similarly. It kicks in when the at-fault driver has insurance, but their liability limits aren't high enough to cover your bills. Your coverage pays the difference, up to your policy limit. In many states, this coverage is optional. Do not treat it as optional. It is one of the most important coverages you can buy, and it is shockingly inexpensive for the protection it provides. You should, at a minimum, carry the same limits for UM/UIM as you do for your own liability. You are worth protecting just as much as a stranger is. Closely related to this is medical payments coverage, or MedPay, and in some states, personal injury protection, or PIP. Think of this as your immediate, no questions asked medical fund. If you're in an accident, regardless of who is at fault, this coverage starts paying for your and your passenger's medical expenses right away. The ambulance ride, the emergency room visit, health insurance deductibles. It's designed to be fast, to get you the care you need without waiting weeks or months for the insurance companies to assign blame. PIP is often more comprehensive than MedPay, sometimes covering lost wages and other expenses, and is typically found in no-fault states. When you see this on your Costco quote, it's a relatively cheap add-on that can prevent a health crisis from becoming an immediate financial one. Finally, you'll see some other options on the quote page. Things like rental reimbursement, which pays for a rental car while yours is in the shop after a covered claim, and roadside assistance, which covers things like towing, flat tires, or running out of gas. These are convenience coverages. They're not about preventing financial ruin, but about reducing the hassle of a bad situation. Before you add roadside assistance, check your other memberships. Costco executive members, for example, get a form of it included. Your credit card or car manufacturer might also provide it. No sense in paying for it twice. So when you look at that quote from Costco and Connect, you're not just looking at a price. You're looking at a fortress. The liability limits are the height and thickness of the walls protecting your kingdom. Collision and comp are the guards protecting your chariot. An uninsured motorist coverage is the elite special forces unit that protects you when the enemy attacks from outside the walls. Your job isn't to find the cheapest possible combination. Your job is to understand the risks and build a fortress that you can sleep soundly in at night. Because the real value of insurance isn't just the check they send after a crash. It's the peace of mind you have every single day until then. So how do we translate that feeling of security into a real, tangible number on a quote page? How do you build that fortress brick by brick without overpaying for materials you don't need? This is where we get tactical. This is where the rubber meets the road, literally. Getting a quote seems simple. You go to a website, you type in your name, your car's VIN, and presto, a number appears. But the devil, as always, is in the details. The number you get is only as good as the information you provide, and a small mistake on the front end can lead to a catastrophic problem on the back end, right when you need the coverage most. Before you even navigate to the Costco auto insurance page, you need to assemble your toolkit. Think of this like gathering your ingredients before you start cooking. It makes the whole process smoother and far more accurate. First, get your current insurance policy's declarations page. This is the single most important document in this entire process. It's usually the first 1 or 2 pages of your policy packet, and it lists every single coverage, every limit, and every deductible you currently have. This is your baseline. This is the champion you're trying to beat. Without it, you're flying blind. Next, you need the vehicle identification number, or VIN, for every car you want to insure. Don't just guess the year and model. The VIN tells the insurance company everything. The exact trim level, the engine size, the safety features it was built with. A Honda Accord LX is different from an Accord EXL, and that difference can affect your rate. You'll also need the driver's license number for every driver in your household who will be on the policy. And I mean every driver. We'll talk more about who that includes in a minute. Finally, you need a realistic estimate of your annual mileage for each vehicle. And please do not just pull a number out of thin air. This is one of the most common and most dangerous mistakes people make. Insurance companies are getting incredibly sophisticated. They use data from state inspections, repair shops, and services like Carfax to get an idea of your mileage. If you tell them you drive 5,000 miles a year for a lower rate, but then you get into an accident and your odometer shows you've driven 12,000 miles in the last 8 months, that's a red flag. In a worst-case scenario, it could be considered misrepresentation and could jeopardize your claim. The easiest way to get an accurate number? Look at your last oil change receipt. It will have the date and the mileage. Find the one from a year before that. Subtract the 2 numbers. That's your true annual mileage. Don't have those? Use your phone's GPS history, or just track it for a week and multiply by 52. Do whatever it takes to get a real number. Okay, you've got your documents, you've got your numbers. You're ready to face the online form. As you start filling it out, you'll come to a question about vehicle usage. It'll give you options like pleasure, commute, or business. This seems trivial, but it's critical. Pleasure means you're just driving for errands, weekends, that kind of thing. No regular trip to a single workplace. Commute means you use the car to drive to and from work or school. They'll ask for the one-way distance. Be honest. But the real landmine here is business use. If you use your vehicle to perform your job, not just get to it, that's business use. Are you a real estate agent driving clients around? That's business. Are you a contractor hauling tools and materials to a job site? That's business. Are you delivering for DoorDash, Uber Eats, or Amazon Flex? That is absolutely 100% business use. If you list your car as commute to save a few bucks, but then get into an accident while you have a stack of pizzas in the backseat on a delivery, your insurance company has every right to deny your claim. Why? Because the risk profile is completely different. A delivery driver is on the road more, in unfamiliar areas under time pressure. It's a higher risk. Most personal auto policies, including the one from Costco's partner, explicitly exclude this kind of livery or delivery work. If you're doing gig work, you need a commercial policy or a special rideshare endorsement. Don't play games with this. The consequences are just too severe. Next, the form will ask about the drivers in your household. The rule of thumb is this. You must list anyone with a driver's license who lives with you and has regular access to your vehicles. This includes your spouse, your licensed teenage kids, and even a roommate if they might borrow your car. You can't just pretend your 17-year-old son with a fresh license and a lead foot doesn't exist to keep your rates down. The insurance company will find out. They run database checks that link people to addresses. When they find an undisclosed licensed driver at your address, they will either add them to the policy and backcharge you for the premium, or they could cancel your policy altogether for misrepresentation. Now, what if there's someone in your house you absolutely do not want driving your cars? Maybe they have a terrible driving record. In that case, you can specifically exclude them from the policy. This means you are formally telling the insurance company that this person will not, under any circumstances, drive your insured vehicles, and if they do and have an accident, there is zero coverage. It's a serious step, but it can be a necessary tool to manage your premium. Finally, you'll get to the section about your driving history. Accidents and tickets. Be brutally honest. Don't forget about that speeding ticket from 2 years ago, or that little fender bender where you tap someone's bumper. The insurance company is about to spend money to pull your motor vehicle report from the DMV and your CLUE report, which is a database of past insurance claims. They are going to see everything. If your version of the story doesn't match the official record, it just makes you look dishonest. The quote they give you will be inaccurate, and when they get the real data, the price will shoot up. You'll have wasted your time and theirs. Just tell the truth from the start. So you've navigated the form, you've been honest and accurate, and you click Submit. A moment later, the numbers appear. This is the moment of truth. You'll see a premium, likely shown as a 6-month or 12-month total. You might see options to pay in full for a small discount or to pay in monthly installments. But don't just look at that big final number. That's the last thing you should look at. Your eyes need to go directly to the breakdown of coverages. This is where you pull out your current declarations page. It's time to compare apples to apples. Go line by line. Your current policy has bodily injury liability of 100/300/100. Does the Costco quote match that exactly? Not 50/100/50. Not 250/500/100. It has to be exactly 100/300/100. Next line. Your current uninsured motorist coverage is 100/300. Does the quote match? Your current collision deductible is $500. Is the quote's collision deductible also $500 and not $1,000? Your current comprehensive deductible is $250. Does the quote match that? You must go through every single coverage, medical payments, property damage, rental reimbursement, roadside assistance, and ensure the limits and deductibles are identical. You cannot compare the price of a fully loaded steak dinner to the price of a hamburger from the dollar menu. A quote that's $400 cheaper is not a good deal if it's because they cut your liability coverage in half and raised your deductible to $2,000. That's not a good deal, that's a trap. Only after you have perfectly mirrored your current policy, creating a true one-to-one comparison, can you finally look at the bottom line price. Once you've done that, you can start playing with the numbers to see how it affects the price. What happens if you raise your liability to that $250/500 level we talked about? How much does it really cost? What if you lower your comprehensive deductible from $500 to $100? Is the extra peace of mind worth the extra premium? The online quote tool is your sandbox. Use it to build that perfect fortress, testing the cost of each and every brick. After all that work, you have it. A true apples-to-apples comparison. The Costco quote is sitting there on one side of the screen, and your current policy's premium is on the other. And let's say the Costco number is significantly lower. Your first instinct is to smash that Buy Now button and start celebrating. But hold on. The numbers are only half of the story. You've confirmed that the what is the same, but you haven't yet considered the who and the how. You've analyzed the policy, but you haven't analyzed the company. So you've done the math, the numbers look good. But is there one last thing you're forgetting? The one critical factor that could make or break your entire experience if you ever actually have to use this thing. Yes, there is. It's the company itself. The actual underwriter. Because Costco doesn't sell you insurance. They're not an insurance company. They are a gigantic, powerful, beloved retail club that has used its immense bargaining power to negotiate a special deal for its members. The company you're actually buying the policy from, the one that takes your money and, more importantly, the one that is supposed to pay you when disaster strikes, is called Connect by American Family Insurance. And this is where the entire decision hinges. You see, a low price is fantastic. It's what gets you in the door. But an insurance policy is not a television. It's not a rotisserie chicken. It's a promise. It's a legal contract that says, if something terrible happens, we will be there to make you whole. And the value of that promise is only as good as the company that makes it. Think about it. The only time you truly interact with your car insurance company in a meaningful way is after one of the worst days of your life. You've just been in an accident. You're shaken up, your car is damaged, maybe you're even injured. The last thing you need is to be fighting with an unhelpful, slow, or difficult claims department. At that moment, you would gladly pay an extra $20 a month to have a smooth, compassionate, and efficient experience. The money you saved over the year suddenly feels completely irrelevant when you're stuck on hold for 45 minutes, getting transferred between departments, just trying to figure out if you can get a rental car. So the billion-dollar question is Connect a good insurance company? Is their promise reliable? To answer this, we can't just look at their marketing. We have to become detectives. we have to look at the data, the real-world report cards that grade insurance companies on what actually matters, how they treat their customers. Our first stop is J.D. Power. They are the gold standard for unbiased customer satisfaction ratings across dozens of industries, and their annual U.S. auto insurance study is a huge deal. They survey tens of thousands of real customers about their experience with everything from billing to the claims process. They then score companies on a 1,000-point scale. So where does Connect land? Well, it's complicated. Their ratings are often broken down by region. In some areas like California, they might score slightly above the regional average. In other regions, they often score slightly below the regional average. They are almost never at the top of the list with perennial powerhouses like USAA or Amica, but they are also rarely at the very bottom. They tend to live in the middle to lower middle of the pack. The J.D. Power score for Connect is, in a word, average. Not terrible, but not exceptional. It doesn't win any awards, but it's not a complete red flag either. It's a solid C+ or B- student. But satisfaction is one thing. What about actual problems? For that, we turn to our second piece of evidence, the National Association of Insurance Commissioners, or the NAIC. This is an organization that sets standards for the insurance industry, and crucially, they track customer complaints. They maintain a national complaint database and calculate something called a complaint ratio. It's simple. A ratio of 1.0 is the national average. A company with a ratio of 2.0 has twice as many complaints as you'd expect for its size. A company with a 0.5 ratio has half as many. It's a direct, data-driven measure of how often customers have a problem so bad, they feel the need to file a formal complaint with the state regulator. So what is Connect's complaint ratio? Historically, it has often floated above the 1.0 national median, sometimes significantly so. This suggests that, relative to their size, they generate more formal complaints than the average carrier. Now, this doesn't automatically mean they are a bad company. A single complex claim gone wrong can skew numbers, but it is a data point we cannot ignore. It corroborates the J.D. Power findings. There might be some friction in their customer service and claims process compared to top-tier competitors. Finally, we have the Wild West of online reviews, Google, the Better Business Bureau, and so on. If you look these up, you will find some horror stories. You will find people furious about the claims process, communication, and settlement offers. But here we need to apply a critical filter. People almost never go online to write, "Had a fender bender. My insurance company handled it competently, 5 stars." Just doesn't happen. The reviews for every single insurance company are overwhelmingly negative because they are written by people at their wits' end. So while you shouldn't ignore patterns in these reviews, you also shouldn't let them be your only guide. So what do we do with all this information? We have a fantastic price from Costco, but it's backed by an insurance company, Connect, that gets decidedly average to mixed reviews on customer service and has a higher than average complaint ratio. This is the fundamental trade-off. You are not getting the best price from a company that also offers the best service. If that were the case, everyone would use them and they'd have no competition. The deal here seems to be that you are trading potentially top-tier white-glove customer service for a rock-bottom price. And that brings us to the most important question. Is this deal right for you? Because the answer isn't the same for everyone. Let's break down who this is perfect for, and who should probably think twice. The Costco Auto Insurance Program is likely a fantastic fit for you if you fall into one of these categories. First, the savvy, price-driven consumer. You have a clean driving record, no accidents, no tickets. Your risk of needing to file a claim is low. For you, insurance is a commodity, a legal requirement, and your primary goal is to minimize that fixed cost in your budget. The potential to save $500, $800, or even over $1,000 a year is a massive win. And you're willing to accept the risk of a less-than-perfect claims experience in exchange for that guaranteed, upfront savings. Second, the self-sufficient, digitally native individual. You're comfortable managing your policy online. You don't need or want a local agent to hold your hand. You're okay with a call center and a more transactional relationship with your insurance carrier. The idea of walking into a brick-and-mortar office feels outdated to you anyway. However, you should be very cautious and perhaps look elsewhere if you identify with this group. First, the service-oriented buyer. You believe you get what you pay for. Your peace of mind is your number one priority. You've maybe had a bad claims experience in the past, and you've sworn you will never again go with the cheapest option. You want the absolute confidence that if something goes wrong, the process will be as painless as possible, and you are willing to pay a premium for that assurance. Second, the person who values relationships. You want a dedicated local agent. You want to be able to call the same person who sold you the policy, someone who knows your name and your situation, when you have a question or a problem. The Costco program through Connect does not offer this. It is a direct-to-consumer model. And third, anyone with a complicated driving history. If you have multiple accidents or tickets on your record, your primary goal should be finding a carrier that will give you the best possible service and advocacy if you have another claim, not just the lowest price. So what's the final verdict? Getting an auto insurance quote through Costco is absolutely 100% worth your time. The process is fast, easy, and the potential savings are significant and very real. For many people, especially those with executive memberships and clean records, the price will be unbeatable. But do not stop there. Quote is just a number. Before you switch, you must understand the trade-off you are making. You are likely getting a top-tier price from a mid-tier service provider. You are betting that you won't need to use the service in a major way, and in exchange you get to keep hundreds of dollars in your pocket. For many people, that is a smart, calculated bet to make. For others, it's a risk they're not willing to take. The decision comes down to your personal priorities, your financial situation, and your tolerance for risk. Costco has done the hard work of negotiating a fantastic discount for you. Your job is to do the final bit of homework to decide if the company behind that discount is the right partner for you on the road ahead.